Hello everyone and welcome to yet another beautiful video that we've created for you in the Knowise knowledge series. I'm Namrata and today we're going to be talking about a very interesting topic called debt funds. So as investors, we love looking at exploring different investment options because we want to diversify our investments, and debt funds is one such option. Now debt funds generally are considered to be relatively safe compared to other investments. But in the last 3 years, there have been certain debt funds in which people have lost money. So I think it is very important for all of us to understand the concept of debt funds and also the different types of debt funds which are available. And before that, we also need to understand what are debt instruments and what is debt market. So in this video, we're going to talk about where exactly the debt funds invest our money. So first, let's understand what exactly is a debt. A debt is nothing but a loan. And when we're talking about a loan, we have a borrower and we have a lender. So now if you look at the debt market, the typical borrowers would be the government or corporates or banks. And the typical lenders would be either individuals or financial institutions like mutual fund companies or insurance companies. Even bank deposit is a type of debt instrument where your banks are your borrowers and your depositors are your lenders. So now we spoke about debt funds and we spoke about debt instruments. So now you must be wondering what exactly are debt instruments. So it's a very simple thing. Your debt funds invest in debt instruments. And your debt instruments are nothing but bonds which are issued by different entities in the market for different durations. So there are two different categories of debt instruments and let's talk about both of them in detail. The first category is your short-term debt instruments, which are basically instruments which are issued for less than 1 year, and they are also called money market instruments. So there are 4 different instruments under this category. So first is your treasury bills, also called as T-bills, which are issued by the government. Then we have your certificate of deposits or CDs, which are issued by banks. Then there's commercial papers or CPs, which are issued by companies. And then we have TREPs or CDLOs. So let's talk about each of them in detail. So first is your treasury bills. So as I mentioned, treasury bills are issued by the government, which means government is the borrower. They are considered to be the safest and the least risky of all. Therefore, they offer the least interest as well in the category. Next is your certificate of deposit, which are issued by the banks. They have slightly higher risk compared to T-bills, and therefore the interest offered is also slightly higher. The next one is commercial papers, which are basically issued by companies and mostly non-banking finance companies. Now they are considered to be the riskiest and therefore offer highest interest rate. Now the objective of a mutual fund is basically to optimize the returns. So the objective of a debt fund is to optimize the returns, and therefore they invest in a combination of CDs and CPs. Next is TREPs or tri-party repo. Now what exactly is a TREP? So TREP is nothing but a one-day loan in which the borrower is the bank and lender is, in most cases, mutual fund companies. So they are basically done for the purpose of overnight lending. Now they are considered to be the least risky of the lot because there's a government security that has to go in as a collateral. So if you look at the overnight funds, for example, the overnight funds tend to invest in TREPs. So now the next category of debt instruments are your long-term debt instruments. Now, long-term debt instruments are nothing but debt instruments which come with a maturity of more than 1 year. So there are 2 types of instruments in this category. First is your government bonds, or we also call them GSEC or gilt. Now, they're obviously issued by the government, which means government is the borrower, and they come with a longer maturity. So a 10-year GSEC, for example, is also called as a benchmark bond and is considered to be the safest in this category. Next is your corporate bonds, which are issued by public and private sector companies. And in most cases, they're issued by NBFCs, which is your non-banking finance companies, or your infrastructure development companies. Now, these generally come with a maturity of 3 to 5 years. So a gilt fund would invest in a government security, a corporate bond fund would invest in corporate bonds, whereas a long-term debt fund would invest in a combination of GSEC and corporate bonds with longer maturity. Therefore, a mutual fund can invest in any debt instrument or a combination depending on the investment objective. So it is very important that you as an investor first understand what your investment objective is before deciding which debt fund to invest in. So for instance, if your investment objective is 6 months to 1 year, then you could look at low duration funds. Whereas if your investment objective is 3 months to 6 months, then you could look at ultra short duration funds. So debt funds in general have the potential to optimize your return. So it is very important that you do your groundwork before deciding where to invest your money. If you've liked this video, do like, share and subscribe. And if there's any particular topic you want us to cover, please mention it in the comment section. Thank you.